So in today's video, I'm going to do part 2 of my 3-part series on buying a business with the SBA. Let me know in the comments what business you would buy if you had the opportunity. If you've ever thought about buying a business, smash that like button, let me know. Welcome back to Mystery Money. My name's Nick, and on this channel, we talk about all sorts of financial topics and terms that surround money. If that sounds like it interests you, make sure you hit that subscribe button and turn on notifications so you don't miss any videos when I release them. Now, with that out of the way, let's get into the video. When you buy a business with the SBA or any lender, you're going to have to obtain certain financial statements and certain documents from the seller in order for the bank or lending institution to underwrite that loan. Now, this can all be avoided if you pay with cash, but unfortunately, that's not an option for a lot of people. Now, the complexity of the financial statements and how intricate they need to be, as far as whether they need to be audited by a CPA firm, whether they need to be compiled, or whether they could just be strictly a Schedule C, will all depend on the price of the business, the sales of the business, and the complexity of how that business was established. There's going to be 3 different types of financial statements that you're going to be provided by the seller. One is going to be your typical tax return. So the Schedule C on the personal tax return of the seller, or it's going to be an LLC tax return. That would be a basic financial statement. 2 would be a compiled statement. So this is if there's multiple parts of a company that an accountant will compile all of those financial statements together to give you one large outlook of sales, net income, things like that for the business. If you're getting value so far, hit that like button so YouTube shares this video out to other entrepreneurs who are looking to buy a business, and maybe we can help them out also. The third type is a more complex, way more robust accounting function, which is called audited financial statements. This is where a CPA firm takes all the receipts of the company and really gets down to the nitty-gritty of the operations and accounting for the business and tells exactly where the money went, how it went, and how the company interchanges funds amongst each other. Typically, they aren't sold to a small business owner. They're more of a conglomerate or a large corporation. And typically they're very public companies and they are actually owned by shareholders. Now, with that being said, I have seen loans for business acquisitions from a small diner with no real estate, let's say $80,000 that they lease, all the way up to $4.5 million deals to where you purchase the entire assets of the business, no real estate, but assets. So there's a wide range of opportunities out there and possibilities. The different types of sales. So one could be a stock purchase. That's if you own a company that's not necessarily public, but has shares of stock. So if it's a corporation and has shares of stock, you could buy a majority of that stock and acquire the company. 2 would be an asset sale. An asset sale is where you purchase all of the assets of the business. So you're not buying the shares of stock, they stay with the seller, but you're buying things such as the name, the inventory, accounts receivable, vehicles, equipment, things like that would all be considered an asset of the business. Now, when it comes down to the actual buying of the business, you're going to need what they call a letter of intent. So a letter of intent spells out specifically what is going to happen and what is going to be transferred between business owner to the buyer. It won't get into the nitty-gritty of, let's say, a sales agreement, but it's basically going to say X company will be sold to Y buyer for X number of dollars. You're both going to sign that, saying, agreeing to the terms that if all the due diligence is done and the company's valuation is proved, that transaction can take place. You're also going to have to sign non-disclosure agreements, which are agreements saying that neither one of you of the parties in the transaction will tell anyone else outside of the transaction other than banks or lending institutions, attorneys, accountants, people that would have those confidentiality agreements with the customers, so they're not going to spread the news out. A lot of this happens with older businesses that may be transitioning to newer generations or phasing out into a different time in their life and retiring, so they don't want the whole community to know that they're looking at selling their business until they're ready to tell. Now, where the SBA comes into play with this, there's very strict stipulations on ownership status and ownership changes. If it is an asset purchase or a stock redemption, to where in either case, the owner of the business currently can stay on as either an employee or as a consultant for a term no longer than 1 year. The SBA does this for a twofold purpose. One, it's to ensure that the new person buying that business has the best opportunity to make that business successful. And what better to make it successful than to have the current owner walking you through that process for at least the first year. When the SBA came out with this guidance of 12 months, it used to be the owner could stay on indefinitely. But what they found is they found a lot of businesses were selling the business but staying on as a high-valued employee, basically paying themselves exorbitant salaries while also taking that payday up front. So they were kind of double dipping in the sale of the company. That's why the SBA came out and said, look, 12 months is it. After that point, you need to exit from the company. As I've found in my own personal experience with helping these businesses, that tend to sell or that they sell their businesses is that 12 months is usually too long. Because after a certain point, when the new owner is taken over and trying to run things the way they want to run it, and the old owner is still there with potential influence for employees and processes and things like that, sometimes they can mesh. Not all the time, but I would say a majority of the time, within 6 months, the new owner has the experience they need or the knowledge they need to continue operations. The old owner can move on to another stage in their life. But the bottom line for buying a business, either SBA or conventional financing, or in general, this is in general knowledge, that business has to cash flow from day one. So it has to be able to pay any debt service on a loan from day one. That is a hard and fast rule for this SBA. The business must show profitability for at least 3 years, and then you're going to need projections for an additional 2 years after that. Now, as far as conventional lending, it's pretty much the same. That business has to show positive cash flow. So it's
all cash, it's under the table, we don't show much of a profit.
That's great, but you're never going to be able to sell that business to a borrower of a loan from a bank. I would not buy a business on hearsay of it's profitable. I want to see the numbers. Show me the numbers that substantiate the price that you're asking for. There's a few other stipulations that the SBA has that the seller is going to have to go along with. Now, this can cause some friction, but ultimately, if they're willing to sell their business and they have a buyer that's qualified and a bank that's willing to lend the money, typically these are non-negotiables. They're going to require tax transcripts from the seller, which means that the seller will sign a form 4506T, which gives the bank or the SBA the right to pull the transcripts from the IRS, matching up what the tax returns say to what they reported to the IRS. And they have to match. If they don't match, there's going to be a red flag and it could kill the deal. Now you say, why wouldn't the tax returns that I provided the bank match the IRS? Well, there's two reasons. One, you could have filed an amended return and then not provided that to the bank. And that could be no fault of your own. It could have been a mistake or you forgot or whatever. That would be unintentional. The other one would be intentional. You have two sets of books. One that you report to the IRS and one that you keep for this instance. This is why the banks require it and the SBA requires it. They want to make sure what you're reporting to the federal government is what you are telling the new buyer. They're also going to have to sign financial statements. So they will have to sign their tax returns, because a lot of times when you file tax returns with the IRS, you file through an accountant or a QuickBooks, TurboTax, whatever. You don't actually physically sign your tax return. They will have to sign the tax returns, and they are going to have to attest that to their knowledge this is the financial health and well-being of the company. I'm going to link below to the various documents that you'll need to fill out for the seller and buyer in order to do a transaction such as this, and some other requirements that I didn't list in the video because this video would be way too long if I got into the whole nitty-gritty of every form you would need. I hope it gives you enough information of what you may need to gather from the seller in order to approach a bank to finance the purchase. I'm hoping to do part 3 here next week. Part 3 will cover the actual closing process and what needs to take place in order for you to receive the keys to that business. Thanks for taking the time to watch this video. While you're waiting for the next video, check out this video here that I did that talks about the difference between cash flow and profit and how a business can be profitable but still not have cash flow. Until next time, have a great day.